Good evening and welcome to the CattleFax Trends Plus Cow-Calf webinar. My name is Chad Spearman. I'm a market analyst with CattleFax. As we get everything spooled up here and running, I just want to double check and make sure that everyone out there can see the screen that we're sharing with you, and also that you can hear the audio from our end. So if you would please, there's a button that you can select that will raise your hand, and then it'll show up to us that you are seeing the screen and hearing the audio. Good deal. Thank you very much. Just for reference, if you do have any technical difficulties trying to watch and listen to today's webinar, it will be recorded and posted online afterwards for your review. As we look forward to today's presentation, we're going to take a look at the fall and winter forage and grain market outlook. We're going to take a look at some market factors and price expectations for the fall and winter calf and feeder cattle markets, and also explore some ideas for expansion here. Before we get started, I'd like to thank Elanco for sponsoring today's webinar, and I would like to introduce Dr. Bruce Hoffman with Elanco, who's going to share some information on vaccines by Elanco.
Thanks, Chad. We appreciate the opportunity to sponsor this webinar. I serve as a veterinarian for Elanco in the cattle beef division, and we're excited to be launching a new line of vaccines for Elanco. And we have two trusted names that we are launching that we launched early this year, the Titanium line and MasterGuard. These vaccines have been in the marketplace and been good, solid vaccines since 1998, and we're happy to have these lines in our portfolio. The Titanium line is a modified live line, and I'll be talking a little bit about that product. MasterGuard is a combination of modified live and killed. Titanium has been around a long time, as I said, but it's just recently that we've had the combinations are now approved for use in pregnant cows and nursing calves. So we're pretty excited about being able to provide the cow-calf industry some good solid vaccines. Next slide. You can see on this slide that there's a lot of combinations. I'm not going to be going over those. You guys will all have access to those, and there's various combinations of the products available for specific use in your herds. Next slide. The Titanium 5 is our newest product that contains a bacterial component and the 5 viruses types that we commonly see in the cattle industry. And we're pretty excited as far as this combination of products in a nice convenient one shot. It also contains both Mannheimia hemolytica and the Pasteurella multocida, which are common bacteria that we face with respiratory disease, followed by the viruses of both BVD1 and 2, IBR, BRSV, and PI3. So this unique combination product does provide good protection. It actually showed reduction of lung lesions in control animals by 83%. So it's a solid product that is in combination and in one shot. Next slide. The big thing is, we're talking tonight, Chad and several CattleFax guys are going to be talking about how do we look down the road and prepare ourselves as what's coming. And one of the things as a cow-calf operator, we're thinking about weaning those calves. Some of you have probably already preconditioned calves. If you haven't, this is a good spot as far as the combination product, preparing these calves prior to going into the feedlot. Also, at this time, you're thinking about retaining heifers, and most producers are talking about retaining more heifers. And the nice thing is this shot fits nicely into preparing those heifers, protecting those heifers, building up their immunity for prevention of respiratory disease that's common. The other nice thing is we also have the lepto with the hard to bolus combination that is an excellent product to give pre-breeding. So as we get into the fall and we get into thinking about getting those heifers ready for breeding, that's an excellent product. Next slide. We can also see, on the stocker or backgrounder, if we're keeping those calves home and we're going to wean those calves, like I said, we got some options with both the modified live with the pasturella, modified live alone, and a killed product. And we recommend that we do revaccinate those in both stocker and backgrounder. Next slide. So next slide, go ahead and skip that slide. And feed yard would be the same as a stocker, with some combinations being available for the IBR and IBR BVD. Next slide. We just, when you look at the cow-calf deal, just remember that this product now is safe for use in pregnant cows, nursing calves, especially if you've been on, we do recommend that you've been on a modified live program prior to breeding. And talk with your veterinarian about the safety and the confidence that we have in the titanium line. Elanco is excited to be part of the vaccine business and working with the cattle industry and providing vaccines now, and actually continue to have a bigger portfolio in the future to help with your needs to keep your calves healthy on your ranch and farm. Thanks, Chad. Appreciate the opportunity to sponsor. If there's questions at the end, I think I'll be around. Stick online to take them.
Thank you very much, Dr. Hoffman. We appreciate the information. Again, we thank you and Elanco for sponsoring this evening's webinar. Next up, we're going to transition into the fall and winter forage and grain market outlook. We've had some significant changes here over the past several months coming through this summer time frame. We're looking at a record large corn crop. According to the USDA's most recent estimate out last week, we have the U.S. corn yield coming in at 171.7 bushels per acre as the September estimate. That's going to be record large, a similar sharp increase relative to the weather-adjusted trend line, which is that blue line working up and to the right, similar to the strong yields that we had in 2009 and 2004, very high levels relative to that weather-adjusted trend line, and obviously well above the drought-stricken crop of 2012. Will, however, be some challenges in here in terms of harvest as we go forward. We do have a situation where only about 27% of the crop is rated mature as of this week. That's behind the long-term average of about 46% mature. So we should see probably a longer enduring harvest here as we go into the fall time frame. But overall, the increase in supply is weighing heavily on corn prices as fall approaches and harvest approaches. With that in mind, you convert that yield times the harvested acreage estimate, you come up with a U.S. corn production estimate from the USDA at about 14.4 billion bushels. And you can see why we've had, just since the last webinar back in June, significant pressure continuing in the corn futures market, which has declined approximately about $1 over that 90-day time frame. With that in mind, we're looking at a record large U.S. production, but also a global record production number as well for the current marketing year, which is 2014 through 2015. So finally, after several years of tight supplies, end users are realizing much cheaper corn, and that looks to be the case here as we go on into 2015 as well. From a usage standpoint, we're looking at total U.S. corn usage here broken down by category, and based on estimates here as of last week's reports, basically looking for total U.S. corn usage, if you pile it all up, at about 13.6 billion bushels for the marketing year, which is roughly par with the same level from a year ago. So some of the changes that we're looking at, expectations are for some decent increases in here from the feed and residual side, largely due to increased production expectations from the pork and poultry sectors. From the export side, we're actually expected to see a small decline in here at this time just due to the larger global supplies overall. And ethanol production is expected to be pretty similar to the previous marketing year as well. One of the challenges here as we go forward is in terms of corn supplies globally. You have the U.S. dollar that is rallying up to the highest levels since late in 2011. And with the large corn supplies around the world, the U.S. isn't necessarily the most competitive corn out there. We're going to be vying for that market share with other countries such as Argentina, Brazil, and Ukraine for that export business. The bottom line, as we draw down to stocks to use levels, that's really the best way to illustrate what our supply relative to total usage is anticipated or projected to be. A significant increase as we come in looking at the current marketing year stocks to use level is at 14.7%. That's taking the U.S. corn balance sheet, the ending stocks estimate, and dividing that by estimated total usage. But the bottom line is stocks to use levels are actually being realized and are expected to be realized on top of 14% for this current marketing year as we go into the spring of 2015. That's a significant improvement compared to the previous 4 marketing years when we were holding back down most of the time between 5 and 7%, pushing at times up on top of 8%. You can see that the long-term correlation there, it's an inverse correlation when you look at stocks to use relative to corn prices as we move from a situation of large stocks to use back at these levels back to these historic lows for the last several years. You had corn prices, this is the U.S. average farm price received. It moved significantly higher to those record high levels. Current USDA estimate is for cash prices to average around $3.50 a bushel for the marketing year. That's down about $1 compared to the 2013 and 14 marketing year. From a seasonality perspective, as we look at the weekly spot corn futures prices, overall the market has been very seasonal here year to date. You had a spring rally moving in towards the March and April time frame. It didn't quite last as long as the last 30 years all rolled up. But moving into that spring time frame, that's when the market's trying to price in that risk premium on concerns over acreage and whether or not production will be enough to meet demand. We've since seen the market trend swiftly lower. The long-term trend remains in place ever since August 2012. But we are nearing this window here where spot corn futures tend to build a base in here over the next several weeks and then seasonally work higher into the end of the current year and working higher in towards the first quarter of 2015. One of the other things to consider in here in terms of forage conditions, not only do we have an increase in total hay production this year, but also as we look at the U.S. pasture and range condition index, it's a really good illustration in terms of how good a shape we're in when we look at it rolled back to the cow-calf sector and the opportunity for expansion as we go into 2015. We've been through several years with a significant drought, especially in 2012, but over the past 6 or 7 years we've had a revolving drought across all regions of the country. This pasture and range condition index is a weighted average of the USDA's ratings that range from very poor through excellent each week. And that runs through the period of May on through the end of October. But what we're illustrating is current year levels, basis the U.S. Pasture and Range Condition Index, are currently record high for this week. They started out very good and they remained strong going through here. The gray cloud in here is the range, the maximum and the minimum range since 1995. So you can see the drastic improvement that we've seen since 2012, which basically marked out the lower end of that range with record poor conditions. Had improved conditions in 2013, right around average, but now we're sitting here looking at very solid conditions across the bulk of the country. With that in mind, one more slide, taking a look at regional pasture and range conditions here. Now we're breaking it up by the different regions, and we're looking at just the most recent week. So that would be week 37. This year that happens to be the week of September 14th. But if we look to the northern plains for week 37, you can see that we're pretty close to record high pasture and range conditions as we're going into the fall. That's comparing this same week to the northern plains condition index for every single year. You can see back in 2013 was back here. 2012 across the northern plains was record poor for this week. Move across to the Midwest. Record good conditions across the Midwest. U.S. very strong compared to historical levels. The Southeast is still working in here with very good conditions. Not record, actually a little bit poorer than a year ago, but still quite good, especially when we consider that the Southeast, the Southern Plains, and the Northern Plains are going to be where the bulk of the beef cow herd is going to reside. Move to the Southern Plains, conditions have improved relative to a year ago, but again, they're much more neutral compared to the long-term range from 1995 through 2013. Conditions in the Northwest also pretty neutral. Southwest, portions of the Southwest have been very bad overall this year, but as we come into this week, we're actually sitting here relatively neutral when you look at the Southwest region as a whole. From a forage price standpoint, we're looking at USDA alfalfa hay prices on a monthly basis. We're still looking at hay prices that for the most part are working lower from a regional standpoint. There's still some significant challenges when you look out to the western region, which is the red line on here. You've still got prices which are holding in here close to the record highs for that region, and yet you have alfalfa hay prices moving in through the northern portion, breaking down substantially in here compared to where we were at the record highs. So as we look forward, we'll take a look at the weather forecast in here that overall has supported pretty good hay production, especially in terms of the native hay production this year with the improved precipitation. But the weather outlook looks good, and the increased supplies out here, coupled with cheaper corn prices, and eventually we'll see cheaper soybean meal and price of protein prices as well, that should continue to weigh on alfalfa hay prices going into next year. Next up, I'd like to introduce Mike Murphy with CattleFax.
Thanks, Chad. We're going to look towards a market outlook from a calf and feeder cattle perspective in here over the course of the next several slides. And as we start that discussion, really the point that we need to make is that it's been very supportive to this calf and feeder cattle market here in 2014. There's two components with that. One, Chad just talked through relative to grain values. We saw the decline in grain values coming through the year relative to 2013. At the same token, with the rally in the fed cattle market that we've experienced, we've seen record large feedlot margins as you go back and look at this data here for the course of the last 30 plus years. And this would assume no risk management. So this is, as a cattle feeder, if you didn't have them hedged, if you were just buying corn every 2 weeks within the ration. But significantly large margins for the cattle feeding segment. And ultimately what we've done is we've healed this industry. If we were to go back and measure this data in here over the course of from 1980 through 2013, on average, we were a break-even business, basically. And certainly, when you look at this last decade in here, we were in an environment where we were dealing with, for the most part, an industry that was losing money. We've completely healed all those wounds, and now we're sitting in here, obviously, with record profits in terms of the market sector. And so as we think about that and we start to look forward a little bit relative to the value of feeder cattle and calves, what we have to be able to understand in here is looking at from a market perspective, where are we relative to the fed cattle market going forward? And that's what this next chart looks at, is the daily Kansas fed cattle price. And you can see this extreme move that we've had in the marketplace going back to last summer, but certainly even since the first of the year, we've had over a 25% move from the low to the high end of the range. And going back to last summer, you'd add another 13% roughly to that full move. So this has been a significant move to the marketplace in the last 12 to 15 months. What you find when you look at this chart is a market that's been very explosive at certain times. And you can see that all the way through here. And now we're in a period as we've had a little bit of a correction and more of a consolidation factor in the market. The question becomes, will we continue to drive this momentum higher and carry the market upward higher into the channel as we look in towards 2015? And what we would say is that the market appears to be slowing a little bit in terms of this rally. That doesn't mean that we're going to have a turnover to the trend anywhere in the next, call it 3 to 6 months, but it does appear that it's slowing a little bit in terms of the trend of the marketplace. And that's the setup that we want to have as we start having the discussion relative to the value of feeder cattle and calves. But before we get into that, there's one thing that we want to point out relative to this market that's had an enormous influence to the fed cattle market, and that's the 90s lean trim. And part of this discussion that Chad went through from a pasture condition index here, we've had great conditions, or I should say improving conditions, for most of the country in here in 2014, at least since the 1st of June. And the net of that has been that the cow slaughter has been way below year-ago levels, and more so even through the summer window than we would have had if we were to look at, say, the first quarter time frame as you look at the 2014 versus 2013 comparison. The net of that has been a very strong 90 lean market. So for most of you understand that the 90 lean beef is just a residual from the cull cow. Most of that cull cow that's harvested is turned into a lean beef item. And so as we kill this many fewer cows, we've had to go out there with higher prices and ration the market sector. And that rationing is due to, again, that smaller supply that we're dealing with. So from this perspective, when we start to think about things from a big picture standpoint, if the 90s market continues to be a sustainable level, then that will be supportive to the fed cattle market as we go forward. The question becomes, if we start to have a correction to the 90s, which would be the strong seasonal for the fall time frame, as we typically harvest more cows, then that's going to put a little bit more pressure on the fed cattle market. And we could see where this fed market would pull back here in towards the low 150s. But from a macro perspective, this overall trend is still higher in here, even as we look into 2015, based on the underlying supply, which is smaller, especially when we look at the first half of 2015 relative to 2014. So that starts to set the stage as we think about the feeder cattle and calf market in here looking forward. And what this data here is illustrating is that you've got, on that right axis, we're looking at the feeder cattle values for this year, which is related back to that black line. The blue line is still on the right axis, and that's 2013 values. You can see on a calendar year perspective what this market has done relative to the seasonal, which is just based off that left index, or excuse me, that left axis, which is the index. And the bottom line is this is a market that's been very seasonal so far in 2014. What we would expect to find is a market that, assuming the fed cattle are going to start to run out of steam in here, we would expect the feeder cattle market to start to run out of steam as well, and could drift a little bit lower here into the fall from this low 230s, mid 230 area, but the risk would not be significant. We would suggest that somewhere in this low 220s should be very good support, and all that is a reflection of this fed cattle market pulling back into the low 150s. Obviously, if this fed cattle market was to continue that momentum going forward, you would expect this market to continue to perform higher going into the end of this year. Now, as we look into 2015 in terms of what we would expect to find in the marketplace, as Chad alluded to, we're building a base relative to the corn market. So corn will have less of an influence in terms of driving the values higher on the feeder cattle sector, because corn's at the low end of the range from this period here at the harvest lows in the fall going into that winter and spring time frame. The transition that the market will start to develop, and this is a follow-up to the webinar that we had back in June, is that we will start to buy cattle deeper into this year and on into 2015 against the summer live cattle market of 2015, which are currently trading somewhere right around $1.50 when you look at June and August live cattle futures. So with that being stated, we would expect to find more pressure on this feeder cattle market into the first quarter. Nothing of any significance, but we certainly could see this market pull back in here towards the low, the 210, 215 area basis the feeder cattle market. And depending on if this fed market is not recovering from a seasonal perspective from your fall low to your spring high, could even find a little bit more pressure. The take-home message that I would have relative to the feeder cattle market, though, is that we're going to have some very violent, volatile swings during the period as we look at the fourth quarter and into the first quarter. This 6-month range, we could very easily have swings tracking from the 210, 235 range when you look at our CattleFax 750-pound seasonal steer price. And so from a big picture perspective, as you start to look at that, the type of ranges that we're really dealing with here relative to the market are not all that significant from a historical standpoint. You know, we're talking about a market that's dealing with from 230 back to 220, less than a 10% move in the marketplace. And that's not a very wide range when we look at the market. But from a dollars per hundredweight, it's very significant. And that's what we'll want to focus on here in a few minutes as we start to look at things relative to strategies, thinking about it from a risk management perspective here in a few minutes. As we shift gears and talk about the 550-pound steer calf market, obviously we've seen a pretty big dynamic shift when you look at this 2014 market on your right axis versus the seasonal, which is just a spot calf market here on your left side with your axis. We've went ahead and have improved this market really since June 1 into the current levels of where we are today. And there's two things to take home relative to that message. One, June 1 was our summer fed cattle lows at 142. And since then, obviously, the market's moved higher. The second thing is as Chadwick alluded to, really for that mid-May time frame, we've seen the corn values drop about $1 per bushel. And then the third thing that's created this pattern of the feeder calf market is the fact that our forage situation has improved significantly. And we believe the reflection of that is that people are going to start to retain more heifers to develop more cows. That means that underlying supply in general from a buyer's perspective is smaller and so they're having to bid up on these cattle. So you've got an environment where this calf market has gone ahead and pushed higher in here through this time frame. And again, this is measuring the spot calf market. Looking into the next 60 days, what we would expect to find is a calf market that's well sustained. You've got plenty of demand when you start looking at the feedlot sectors. We've talked about those margins. It appears from a subsoil moisture perspective today, you're going to have a lot of potential for winter wheat grazing through that whole Southern Plains region. And then with all of this excess forage that we have out there, we're going to have the backgrounding segment to the whole Central Plains that's going to be dealing with extra feed to go ahead and be looking to background calves as well. And then the final component is looking way out towards 2015. We're in an environment where it appears if we get some timely moisture next spring, we're going to have a great start to the summer grazing season as well. So you've got really 4 segments of the industry all in the potential buy mode from a market perspective. And that's going to be supportive to the calf market all the way through the remainder of the year. We wouldn't expect this market to get significantly higher, but certainly sustaining these values as you go through the fall time frame. As you look out there into 2015, we would expect the market to be very seasonal. So wherever it's starting in here in late Jan time frame, we'll move higher into the spring. Obviously, Mother Nature will dictate how much higher, but we would expect to see this market go ahead and push higher into that time frame. So these are some of the things that we're monitoring here very closely, but it looks very supportive to the calf market as we look forward here. So let's think a little bit just about some of the strategies as you look at it from a stocker perspective for both the winter, spring stocker operations, which would include the backgrounding operations as well. Number one, when we start talking about calves at $1,500 to $100 a head, we've got to make sure that we've got to keep these calves healthy because we've got to have a live animal out there that can perform for us when we start looking at the input costs that we're dealing with from a first cost standpoint. The second thing is it appears with where things are setting up today that our winter costs are going to be lower. When you start looking at feedlot cost of gains through the Midwest area, somewhere around 70 to 75 cents, and then as we move south into the Central Plains, somewhere probably in the mid-80s, we've got to see a reflection of a pretty, a normal discount for these winter costs from a backgrounding and winter grazing perspective. And we think we'll see that as we get in here towards the fall. A lot of these winter backgrounding costs will likely end up being somewhere in the 50s when it's all said and done with. Thinking about it from an interest perspective, interest is probably not going to change a lot right here in front of us for the next 150 to 180 day window. But obviously with the announcement today from the Fed that we're going to see interest rates start to move higher over the course of the next 12 to 18 months. I think that's very clear. You can see how the market responded to the announcement from the Federal Reserve today, and we just got to keep that in perspective. Short term, not a big deal, but longer term, we want to keep that in mind. Here's the bottom line. As we start looking at our operations, it's about equity protection. In both phases of the feedlot and the stocker segment, 2014 have been a very good market in terms of margins and returns. But now as we look in here, we're having to give an extra $500 a head for these calves up front. We got to start looking at equity protection. And that equity protection could be a combination of hedges, options, forward contract as you start to kind of procure your animals. The one thing that we would look at is that the longer you can wait to buy your animals into the end of the year, we feel like that's a cost savings as a part of that winter cost. Now, you've got to offset that with the health side of things, but that is something to take a look at. We would encourage operations to be looking at protecting a portion of our investments as we look out there towards 2015. Doesn't mean that you're fully 100% hedged, but we need to have strategies in place to be protecting equity. And the reason why I say that is it goes all the way back to some sort of an unforeseen circumstance. If for whatever reason this channel that we've developed in here does not continue with this upward momentum in the market, and we start to break this channel, what would that be in terms of the impact on feeder cattle market? That would be very significant. And so being able to be responsive to the marketplace, we've got to be in mind looking to protect equity from the get-go. It's not 100% protection, but certainly protecting some of the equity in the market sector. The final thing that I want to talk about relative to just the cow-calf segment on the market side is the cull-cow market. Obviously, as we just talked about the 90s lean market, and you saw on that chart that rally that would have started in here since the 1st of June, this is the reflection of the cull-cow market. If we get a pullback to the 90s market as we expect with bigger cull-cow slaughter, we'll see these cows pull back. And we can pull them back 10, maybe even $15 a hundredweight. If you're looking at trying to carry those cows as you wean calves this fall into next winter, from a market perspective, we see great value to that decision, just as we did coming from 2013 into 2014. We see a lot of value with that decision. The thing that we want to take a look at is we kind of transfer our thought process and start looking at whether or not we're going to be looking to expand, but to follow up thought relative to carrying your cull cows. And that's starting to look at the precipitation and temperature outlook for 2000 and the tail end of 2014 and on into 2015. And Dr. Art Douglas, who most of you know has been a part of the weather forecasting for CattleFax for on top of 30 years, has put out his latest forecast. And what you'll find in here, through a lot of this Central Plains area, you've got an increase of precipitation as you look into the September and November time frame. Now, when you look a little bit deeper into that December through February time frame, which is really where we're focused in on that cull cow, regionally you see some differences. So if we're talking about less precipitation out there in the winter plate and the northern plains, that would make some sense for you guys to take a strong look at carrying your culls, because it would appear that weather would have less of an influence on you in terms of feeding those cows throughout the winter time frame. There might be other parts, say this upper Midwest area, Iowa area, northern Missouri, and we know how many beef cows are in those regions, on top of about 3 million cows. That's a spot that we want to take a different look at. We may say, hey, weather might be a preventing factor for us. So the key is here is to do the math relative to your cost structure as you look at things in terms of carrying those cull cows from this fall into next winter. Now, looking at the market situation, and we want to have a follow-up discussion of what we talked about here in the June webinar, and that is what we thought we'd foresee relative to the bred cow market. Obviously, as we look forward here, we have to start to believe that we've got more confidence from a forage perspective in the next couple of years, just based on what we're seeing here with Dr. Douglas's forecast from a precipitation perspective. Now, clearly, this is regional, and there are still some areas of the country that will have some challenges as we look at things, but for the most part, we're in a better situation. So the question becomes, as you look at it, number one, how much is a bred cow worth? Well, if you think back to our webinar back in June, as we were looking at a calf market to be trading in this area here of 210 to 230 a hundredweight, on an average perspective, this is where we thought bred cows would be trading. Now we've got an average calf market on top of 250 to 260, and now we've got average bred cows bringing somewhere between $2,200 and $2,300 a head. Obviously, regionally, if you're in the core of the central part of the U.S., we've got cows bringing on top of $2,700 a head. No surprises. The math works. You know, it's 1.5 to 1.6 times the value of the calf market is where the bred cow should be trading at. The math is working. The question becomes, do we go ahead and look to buy cows, or are we looking to develop our own heifers? And this is just a simple, a simple kind of a track sheet for you to decide what are the pros and cons. In a bred female perspective, you get a quicker return on your investment. Obviously, you got the depreciation value, which may come in handy because of these higher returns that we're dealing with at the cow-calf sector. You've got some flexibility in terms of that calving window because you can kind of determine what type of cows you want to buy. And one that still is important for a lot of producers, especially in country where you got a lot more country to cover, you avoid calving those heifers out. Now, in terms of developing the heifers, hey, you get to depreciate your expenses. The most important, though, is you get to predict the genetics. You know exactly what you're dealing with because it's your own heifers. You're utilizing your own AI sires or bulls, if you will, looking into breeding these heifers. There's also more flexibility relative to this in terms of if you want to start shifting your calving period a little bit later or earlier in terms of your market, in terms of your regional situation. You have the opportunity that if you see enough return, you can go ahead and market those bred heifers. That may be good and bad because you may be forced to if Mother Nature doesn't work for you. And then as we start thinking about it, marketing calves for first calf heifers, what's the value of those calves? And that's something that can be a detriment to you. So as we start looking at it from an opportunity perspective, number one, if we're looking to go out there and be buying our bred females, it's all about what the market suggests from a seasonal perspective. And I'm going to jump down to this next slide and just show you that seasonally the market goes higher into the spring. All that is reflective of is that people don't want to buy cows and then feed them all winter. That's the difference of the market. So depending on your winter cost, you may be better off buying your bred females now into the fall than waiting in towards the spring time frame. And again, that's part of that whole forage outlook, Dr. Douglas's forecast to the weather. When you start to look at some of the cows that you may have on the place, you have an underperforming cow that's got a live calf not doing very well. Maybe you want to keep her around for another year. The key thing is what about retaining these heifers? And that's what we want to spend a little bit of time on as we start thinking about the marketplace in here. Why are you wanting to expand? Whether it's retaining heifers or not, you need to address why you're wanting to expand. Is it because you're trying to build back from the drought? Are you trying to expand your operation as you bring more people into the operation? You're diversifying your operation. You've got to understand why you want to expand. And then the second thing is once you've identified the why, then you start to look at what that production risk is. And the thing that we want to highlight in here is, are we at the higher end of the market sector? Are we forming a cyclical high in this market somewhere here in the next 1 to 2 years? And that's something that we've got to be very conscious of as we look at the market. And we'll get into a little bit more detail about in here in just a second. If you are developing heifers, here's the thing that we can take a look at. You start to go through and you say, your first cut when you're going to breed out there next spring. Hey, the ones that you don't like, what are they worth? Is there still a potential return on those? Can you protect yourself on that return with the futures market where it is today? Those are types of things that we have to evaluate in the marketplace. The second thing is basically the same sort of assessment. It's a pregnancy check out there towards the late summer, early fall next year. Again, what's that open heifer going to be weighing? What's her value? Do we need to be protecting ourselves in terms of that equity protection in the marketplace? And then obviously as we go all the way out there in terms of the third cut, way out there towards the 15 months from now, reevaluating those value of those females from a overall structure perspective, performance, all those types of things. We would really encourage you to take a look at this whole concept relative to just like retained ownership. Go through each phase. See where the risks are from a production standpoint, where the risks are from a market perspective if you end up with heifers that you don't think are the right quality that you want to breed next spring. Go through that concept, and this is just part of our retained ownership guide that we look at. Why not we manage this the same way that we would our cattle that we retain ownership onto the feeder or stocker phase? The other thing that we've got to look at in here is just these cost structure. Okay, so what are the trade-offs? What's the opportunity cost in terms of selling a heifer calf or developing her into a bred female? What's our cost structure? Chad alluded to the fact that alfalfa values should go down here over the course of the next several months. The biggest factor might be, and probably really is, Mother Nature. We've got to be able to identify Mother Nature. Is it going to be more favorable or not? And we would just tell you, as we start to look forward in here, we believe that Mother Nature is going to start to overall shift to be more of a wetter pattern. And Dr. Douglas believes that we're coming out of a phase of this 20-year drought, and we're going to slowly move back to where we're more of a wetter pattern over the next several years. That's not to suggest there won't be some dry periods, but they won't be near as severe as what we just came out of the last 20 years. And then how do we recover that expense, if you will? And that really goes to our summary slide. As you start thinking about your operation to whether you're developing your own heifers or you're buying bred females, you think about it from a revenue perspective. We believe that this calf market sustains somewhere between $900 and $16 a head over the next 4 to 6 years. And that assumes expansion. So we believe that this market is very well supported. If we think about it from a fed cattle perspective, this low 130s area, maybe we have to get somewhere a little bit cheaper than that in a real extreme environment, but that's an underlying supportive level to the market. And as we think about it, at least in the next 2 to 3 years, if Mother Nature is going to cooperate, we should be able to sustain corn values between $3 and $5 a bushel. All this leads to a calf market that's going to sustain in this $900 to where we were last fall to $1,600 at the high end of where we are this fall. From an expense standpoint, obviously, your seed stock, your bulls are going to cost more. Energy is likely going to sustain these current values and could go higher longer term. Feed costs will track with corn. I think in the next 2 to 3 years, your corn costs and your feed costs from a hay perspective are pretty well defined. Obviously, as we look longer term, if we get into more demand or a drought somewhere in the corn belt, we could always see where hay costs could go back, or excuse me, hay and corn costs go back to the high end of the range. But we feel like that those are more manageable as we look at things. And then the final thing is, again, from Dr. Douglas's perspective, we're shifting away from this long-term drought pattern. Doesn't mean that we're fully out of it, but the droughts will be less severe and shorter in nature as we look at the next 3 to 5 years. There will be a drought here in the next 3 to 5 years across this country and significant in some regions, but it won't be sustained like it would have been maybe as we go back to the 96 drought, the early part of this last decade, the 2011 and 12, that type of an environment. So with that, we would encourage you to start to do the math, look at these opportunities in terms of expansion, and if you have any questions, feel free to reach out to us. We've got our time for just a couple of questions in here, and one of the questions that we have is we sell our heavy calves then backed by light ones. What are your thoughts on this being profitable? And I would say that I think that your trade-off is a pretty good one. You're going to be able to add cheaper gain with that lighter calf going into your summer grazing program for next winter as you look at, or excuse me, next summer as you look at it. So I do believe there's an opportunity with that type of an environment in terms of the market sector. In terms of another question that we have relative to the discussion today is that should we be looking to take on a big hay supply as we look in here towards 2015? And I think that the message that that came home from Chad was that you don't necessarily need to take on a big hay supply. Mother Nature should be working towards our advantage to start producing bigger supplies as we go forward, and we'll be watching that very closely. And then one final question as we try to wrap up the discussion here is that with inflation, does record cattle P&L, does that hold true as well? And that's a great question, and I guess the way that I would answer that is that it's more relative to your return on your investment and also your replacement investment. So I think the way that we've seen record margins in here, it does hold very well in terms of being a great environment that we're dealing with. But all of us, as we look to buy animals back, whether that's a feedlot looking to buy replacement feeders back or a cow-calf operation looking to buy females back, the lender's still going to be asking for that 20 to whatever 35% down. And so a lot of these returns that we've captured, we're having to feed those right back to buying that next animal back. So we may not have been able to share in these record margins to the degree that we would like to, just because of that replacement cost, if you will. So one last question that we have, just real quick, where do you see the 90s lane coming from support in terms of demand? And it's really more of a supply perspective. The 90s market is being driven by supply, and it's just such a short supply both here domestically and then what we see in terms of an import perspective, and that's the driving force of what's pushing and sustaining this 90s market as we look at things in here right in front of us. Well, with that, we want to say thank you again to Elanco and Dr. Hoffman for their sponsorship and their support of the Trends Plus webinar. We feel like that we've gotten a lot of good feedback from these webinars as we look forward in here. And we have another one that's actually planned that's going to be on September 21st of 2015. That'll be our next webinar. We would encourage you, though, to take a look at coming down on December 2nd of this year for our Outlook and Strategy session. This is a day-long session that provides a great insight of what we expect going into next year. Not only will Dr. Douglas be there and the CattleFax staff, but we have the privilege to have Jan Lombrecht from Rabobank, and he'll have some great insight from an economics perspective, both domestically and globally, and that really sets the stage of how we view markets over the next couple of years. So we'd encourage you to take a look at coming down for that. And with that, we appreciate your time, and again, appreciate Elanco, and we will talk to you soon. If you have any questions, feel free to reach out to either Chad or I. Thank you very much.